and welcome to one of our regular fund updates. Thank you for taking the time to join us, as today I'll provide you with the latest information on the Charter Hall Direct Industrial Fund No. 4. For those who don't know me, my name is Steve Bennett and I have the pleasure of heading up our direct business at Charter Hall. Today I'm going to talk you through the fund's performance, a couple of case studies on how we like to acquire assets, and also cover off on recent acquisitions as well. But before I do any of that, I do want to bring to your attention this disclaimer up on the screen. I would encourage you, if this fund is something that you're potentially interested in, please always do read the offer document in full, including the risk section, and consult your financial or other advisor. Before I get into the fund-specific information, since our last update, Charter Hall, which is the manager of the fund, has released its latest group results. Very pleased to say that the group now manages over $40.5 billion, and we're invested across the core asset classes of industrial and logistics, office, social infrastructure, long WALE diversified funds. And what you can see here, that last point around the focus on long leased assets has continued despite the growth in the business. The slide you can see up on the screen is the direct suite of funds that are currently still being managed by Charter Hall. A number of them are already closed to new investment, but you can see there the ones on the right which are open. The blue bar is the fund's performance and the grey bar is the benchmark return based on the MSCI Wholesale Fund Index. Very pleased to see, as you can see there, every single one of those funds is beating and exceeding their benchmark. So before I get into the specifics on the Direct Industrial Fund No. 4, or we love our acronyms DIF4, it's probably worthwhile touching on some of the key drivers of the industrial and logistics property sector in Australia. The first is pretty obvious. The continued growth of e-commerce means you need more warehouses and distribution centres to ship goods from. The demand side, it's been driven by a whole raft of investors. So you've got high net wealth investors in Australia, Australian superannuation funds, Australian institutions, but as well you have global investors focusing increasingly on this sector. It means there's a lot of pent-up demand for high quality industrial and logistics real estate. And finally, I'll just highlight the supply. In some markets, the release of industrial zone land hasn't kept up with that strong tenant demand. What that's meant is that we've been able to see some good rental growth coming through in those markets, and particularly in areas such as Sydney, which have continued to show steady and consistent rental growth over a period of time. So now I'll just bring you to an update on the Direct Industrial Fund No. 4. DIF4 is an open for investment fund, meaning investors can get access to it. It provides rolling 5-year liquidity events, with the next liquidity event scheduled to occur at the end of next year. I believe it's the largest unlisted fund that focuses purely on industrial and logistics that's available to retail investors, high net wealth investors, as well as self-managed super fund clients. So what does the fund look like? Well, the key things to note are up there on the screen. The fund is almost $950 million of assets. We're currently in due diligence, so we're looking at investigating approximately $200 million of assets, which we expect to come in prior to Christmas. Unfortunately, I can't give you any more information on those at the moment because they are confidential, and until we sign binding contracts, we never release this information to the public. In terms of the occupancy rate, it's 99.9%, and this has the longest lease term of all the direct suite of funds that are currently open for investment, with a little bit over 11-year WALE. And remember, WALE is simply weighted average lease expiry. The quarterly distributions are probably even more important to our clients in the current climate. What you've seen, not just an Australian phenomena, but across the world, is that as interest rates have fallen to zero or close to zero, the ability to generate regular and growing income streams for our clients is much harder. So core quality real estate, which can provide, in this case, a little bit over a 6% per annum income return, is being highly sought after. And we're seeing that based on the very strong monthly equity inflows which keep coming into this fund. In terms of some of the other key performance metrics, you can see here on the screen on the right-hand side the fund performance over multiple periods, 12 months, 3 years, and since the fund was originally created. In all periods, it's exceeded the benchmark returns. What I'd also bring your attention to is the debt facility and the relatively low gearing rate. We are looking to push that gearing level up, and as we deploy the equity that we're raised into those new investments, you will see that gearing head towards a long-term gearing rate of 30 to 40%. In terms of the debt facility, we're very close to financing almost a doubling of that debt facility, which will mean we've got capacity to further grow and diversify that portfolio for the benefit of our investor customers. This slide has a lot of numbers on it. It's basically a quick snapshot of the key assets in the portfolio. But what I'd probably say is just look at the blue line down the bottom, which has the totals. And the one thing which I haven't talked about, which is the far right column, shows that the regular fixed average rental increases, so that's the amount that the income of the fund grows each and every year, provides that growing income stream which our investors are used to and which they love in terms of being able to support themselves and build their investment returns. The next slide shows two things. So who are the key tenants in the portfolio? And remember, the tenants are the ones who are paying that rent, and that rent is what's ultimately passed through to our investors in the form of those regular quarterly distribution payments. The picture of the Australia diagram shows how the assets are spread across the country. One of the benefits of this fund at almost $1 billion of assets is it's well diversified by both tenants and geographic location. In terms of the tenants, this is something we focus on very carefully and we take very seriously at Charter Hall. Because they are the ones that pay the income, making sure you do your due diligence on them up front is a key part of what the transactions team and asset management team, as well as working with the fund manager when we're looking at these assets. So the key tenants being Ingham's, Visy, Wink, DHL, a global distribution and shipping company, Super Retail Group. These are all the type of tenants which we focus on. Main Freight, which is a $4 billion market cap New Zealand listed company. These are the tenants that are paying the rent in Div 4. I'm now going to wrap up. I'm going to give you a couple of case studies. And what they're going to do is show you how we like to source assets for our funds. It's important that investors understand this because I do think this is a key strength and something that sets Charter Hall apart from other managers. Our ability to access the highest quality assets, to do full and comprehensive due diligence, and to be able to complete that in the timeframes that meet the seller's requirements means that in many cases we've got a head start on other competitors when we're bidding on assets or trying to get assets off market. And actually that's probably a good lead-in. There are two main ways that assets are sourced. What's called on-market opportunities, which is effectively when the seller puts adverts in the paper, runs a full campaign, advertises widely, and basically throws it open to the entire market to approach them and put expressions of interest and bids in on their assets. The other way is called off-market, and this can be a limited number of potential buyers are approached, or as is common through relationships that we may have with either the tenant or a particular selling entity, we may get first look at assets, and meaning if we can agree a price that works for both the seller and the buyer, we're in a strong position to buy that. But I'll walk through a couple of examples which I think will draw out the differences in a little bit more detail. The first case study up here on the slide is an on-market acquisition, but with a twist. So the selling entity put out the adverts, put out the information memorandum, and had a fixed date when any interested party needed to submit bids. The way it usually works is you submit your bid, there's a number of rounds of that, and then you go do your due diligence before you sign a contract. However, because of Charter Hall's background and knowledge of this asset, we knew we wanted this for the fund, and we undertook the due diligence in that initial period, meaning that when the offers were due for submission, we presented them with a signed contract, meaning that the seller had a lot of certainty that Charter Hall and the Direct Industrial Fund No. 4 could complete. And we like to generate these win-win scenarios. So it put us in a very strong position and helped us secure that deal. And from a seller's point of view, they liked the certainty that they got. So it meant we did take out a lot of that competitive tension that usually happens. In terms of the asset, well, we picked up a very long-term asset, has a great bank guarantee of over 2 years, very unusual to get that. And one of the things we really liked about it is it's basically food infrastructure that's so critical to that WA market. We're always thinking about the exit and how important that asset or property is because we are long-term owners of property. Another case study, which is now up on the screen, shows how we partnered up with a corporate entity who we knew was doing a big corporate relationship, and we acted as their takeout for the property piece. So what this meant was this asset wasn't advertised widely, but through our relationship with that entity meant we're in a very strong position and were ultimately successful in buying that real estate. And what exactly was that real estate we bought? Well, it was a 20-year lease to a wholly owned subsidiary of Visy. And for those that aren't familiar with Visy, it's one of the largest privately owned packaging groups in the entire world, and it benefits from what's called a triple net lease. A triple net lease, for those that aren't familiar with it, simply means that the tenant is up for all costs related to that property. That means your regular costs like rent, electricity, repairs and maintenance, and because this is a plant that's so important to them, they're also up for the capital costs on the building. So triple net leases are something we really like. In this case, the tenant wants to be able to control the whole facility, and it means from an investor point of view, we're not up for any capital expenditure or other costs. We simply collect that rent and we benefit from that very long-term lease that's in place. The next case study, which you can see up on the screen, this was a limited market campaign. And one of the things that put us in a strong position was our existing relationship with the tenant. In this case, the tenant DHL was looking for a partner to help build them a new property down in Melbourne, and they wanted a 10-year lease. So DHL is a global company. It's a perfect tenant that we always try and achieve in our portfolios. And we already had DHL in one of our wholesale funds, so we knew the right people to talk to. They were very comfortable in how we manage properties, because if you're going to sign a long-term, in this case, 10-year lease, you want to know that the landlord's someone that's going to look after the property and someone you can work with. So what it meant was that put us in a very strong position, and ultimately DIF4 was successful in acquiring this asset. What I would say, although it's an asset that's under construction, DIF4 will not take on that speculative development risk. We have a fixed price building contract. In fact, DHL are building it, and we just write them a check at the end. And we have a binding lease, what's called an AFL, an agreement for lease, which kicks in as soon as that property is completed. So these are a number of examples of how DIF4 has been able to source high quality acquisitions to further improve the portfolio and ultimately drive greater investor returns in the fund. Finally, you can see up here on the screen the contact details of the trust team, myself, Miriam Patterson and Chris Choi, as well as the direct investor line and the people there. For any administrative questions, if you're looking for statements, unit prices that you can't find on our website, please do call the registry. But if it's a specific question on the fund, please do contact us. Remember that we'll only be able to provide factual information on the investment. We are not in a position to give anyone financial advice. Thank you very much for joining us today. I hope you've gained some additional insights into the Charter Hall Direct Industrial Fund and a better understanding of how we like to acquire assets. This kind of philosophy is how we deliver superior returns, not just across Direct Industrial Fund number 4, but the entire suite of funds. If you've heard anything that is potentially of interest, I just remind you to please always read the offer document in full and contact your financial advisor. Thank you very much.